Did you know that Ireland is the third richest country in the world in terms of per capita income, almost 40% higher than the United States? What's even more impressive is that Ireland has achieved this position in such a short period of time. 30 years ago, Ireland was slightly behind the European average, but today it is almost 3 times richer. During the 70s, 80s, and 90s, Ireland received billions of euros in subsidies from the EU. Now, on the contrary, they contribute billions of euros. Ireland is known as the Celtic tiger, similar to the rapid rise of the 4 Asian tigers: Hong Kong, Taiwan, Singapore, and South Korea. But there is just one small problem like this. The Celtic tiger is a paper tiger, but the numbers are real. But what they imply is not. The so-called Irish economic miracle is a mirage, carefully preserved by the Irish government. But why? We have to go back to 1980, the year that changed everything. That was the year Apple became the first foreign tech company to manufacture in Ireland. Cook, the CEO of the Cook team, praised Ireland for having a talented and adaptable community. In the company's official version of the story, that's the whole story. Apple took a chance on this small developing country, and both have grown together. Apple's press release for its 40th anniversary repeatedly mentioned the Irish family and community. But if you go back further, you'll hear a different story. Since at least 1956, Ireland has pursued business-friendly policies such as generous 10-year tax breaks for foreign manufacturers. But after Ireland joined what would become the European Union in 1973, it had to phase out those benefits starting in 1981. In other words, Apple stepped into Ireland at the 89th minute and successfully secured its last tax break for the next decade, which was also the most vulnerable period for the company, during which Steve Jobs was replaced by former Pepsi CEO John Sculley. He initiated a massive restructuring that ended up costing the company billions of dollars and putting it on the brink of bankruptcy. Ireland wasn't doing much better, with nearly a quarter of the population unemployed. So as the 10-year period began to wind down, Apple approached Ireland with a proposal. They would shift almost all of their global revenue to Ireland, but Apple would pay an effective tax rate of less than 2%. And 2% may not sound like much, but without Apple, Ireland would not exist. In return, Apple would have a safe haven to park its international profits. In a cash-strapped environment, Ireland accepted the offer without much hesitation. But for the deal to be legal, Ireland would have to do the opposite, drawing up rules that would generate the 2% figure. And that's how Apple set its own tax rate. Now let's get to know the infamous IRS Form 8832. Before that document, American corporations had to pay U.S. taxes on their worldwide income. That means whether you sell your chain in California or South Africa, you still have to pay taxes to the U.S. government. Most recently, the tax rate was 35%. But since 1996, U.S. corporations have been able to avoid this tax as long as their money stays overseas. A year later, Ireland passed a similar law. Today, companies pay tax only in the country where they make major decisions. In other words, wherever they want, preferably nowhere at all. So in the U.S., Apple has argued that its subsidiary is actually Irish. And in Ireland, they can say that the company is actually headquartered somewhere else, like Bermuda. That's the first step. Apple set up a subsidiary in Ireland, where taxes are low, but they still need to transfer their international profits to that company. Just suppose, folks, you walk into an Apple store in Vietnam and buy an iPhone. That profit should go to Apple Ireland, not Apple Vietnam. To ensure this, Apple has resorted to intellectual property. It's a perfect way to avoid taxes. For one thing, it's extremely valuable. This bitten apple is worth a fortune. 2, but it's incredibly difficult to value. Who knows if this apple is worth $1 trillion, not $1.2 trillion. By shifting these priceless yet invisible patents, logos, and brands, Apple can shift profits to a late-rising destination. They simply license their intellectual property outside the U.S. to their Irish subsidiary. Then, whenever an iPhone is sold in Vietnam for, say, $1,000, Apple Vietnam will have to pay Apple Ireland, say, $980 for the use of the trademark. This way, 98% of the profits will be allocated to Ireland to enjoy the low tax rate. But here's the thing. Ireland's corporate tax rate is 12.5% on paper. To get it down to under 2%, Apple has declared its Irish subsidiary taxable somewhere like Bermuda, where the tax rate is even lower. Except Ireland applies a special 20% tax rate to transactions to notorious tax havens like Bermuda. So Apple needs to transfer the money through an intermediary, another company, this time in Halat, where the Irish company will sublicense its intellectual property. Next, Apple sets up a second Irish company to which the Dutch company sublicenses its intellectual property. Finally, the second Irish company licenses its intellectual property to Apple's subsidiaries worldwide. Now imagine you walk into an Apple store in Vietnam and buy an iPhone. Apple Vietnam says that much of the value of that purchase comes from intellectual property it doesn't own. So Apple Vietnam pays royalties to a second Irish company, which also doesn't own anything. It also paid a fee to the Dutch company. The Dutch company also forwarded most of the money it had just received to the first Irish company. Finally, the company said its major decisions were made in Bermuda, where the corporate tax rate is at or near zero. So what? Apple pioneered this tactic, which it calls the 2 Irish, 1 Dutch sandwich. And Apple isn't the only company to use it. Google, Microsoft, and Facebook all do it. In the 1990s and early 2000s, American multinationals were increasingly making profits overseas, and billions of dollars of that came from Ireland. But by 2013, the public began to notice the ploy, and the U.S. Senate held several high-profile hearings with the Cook team. Eventually, the companies announced that the old strategy was over, and Irish companies would now be taxed in Ireland. Apple's first Irish subsidiary can no longer claim to be a tax resident in Bermuda. But don't worry, because generally the tax treaties supersede the local laws, and companies simply replace Bermuda with a country that has a tax treaty with Ireland. In Apple's case, they chose a name you've probably never heard of. Wait, a British territory with a population of just over 100,000. Now it is clear that Ireland is a tax haven. So the question is Ireland's economic miracle really a miracle? The country is one of the richest in the world with a GDP per capita of over $100,000. Even in 2015, Ireland grew by 25%, while the two stars, China and India, only grew by 7 to 8%. Many experts say the statistics paint an illusion. Ireland is no different from Bermuda, the Bahamas, or the British Virgin Islands. For example, look at what happened in 2015. Irish workers didn't suddenly become 25% more productive. Irish companies didn't suddenly export 25% more goods. No, Ireland just opened a new loophole after closing the wheel loophole. Starting in 2015, companies can deduct the full cost of intellectual property they buy from their tax bill. And so companies bought a lot of intellectual property, of course, from themselves. Companies like Apple have transferred trademarks and patents worth about $270 billion to Irish subsidiaries. On paper, they are no different than oil or refrigerators, so Ireland's GDP suddenly increased by 25%. That's why people think this economy is not real, or worse, it is not generating real benefits, but the costs are real. Foreign multinationals dominate tiny Ireland, indirectly contributing to the housing crisis. Between 1991 and 2007, house prices in the capital Dublin rose 429%. Second, Ireland's economy is heavily dependent on a very small number of American corporations. Just 10 entities contribute 60% of the country's corporate tax revenue, with the top 3 alone accounting for a third. In 2021, Ireland was forced to sign an agreement with the Organization for Economic Cooperation and Development that sets a global minimum corporate tax rate of 15% and requires profits to be redistributed to the country where the actual transaction takes place. As history shows, Ireland could, will, or has already created a new learning hole. After a sensational hearing in the U.S. Senate, the European Union opened an investigation into Apple's tax practices. The court ruled that Apple must pay Ireland $14 billion in undertaxation. But anyway, do you know how the Irish government reacted to this $14 billion? To the confusion of the people, the Irish government angrily protested this decision. You must be thinking that Ireland wants to let the iron floor go, catch the crazy fish, and give up a small profit in the present for a long-term benefit in the future. But this is not a small amount of money. Ireland is a country of only 5 million people, and its entire annual health budget of $14 billion could be spent on healthcare. Furthermore, lower corporate taxes are just an alternative means to achieve the same goal. This is because Ireland is not just a tax haven. After all, there are plenty of safer, cheaper, more secretive places to stash money. Ireland isn't even the lowest tax jurisdiction in Europe. Apple could certainly find a more favorable tax haven. What Ireland is really selling is its reputation as a country that has not been debunked. The economy works like this. First, Ireland's real economy, that is, the people who actually go to work and produce goods and services, gives the impression that the economy is completely normal. Second, because of this perception, companies that do not want to be seen as a tax haven will choose Ireland. Third, by doing so, companies will exaggerate the economic situation in Ireland, creating the appearance of oil. Finally, lobbyists will use this economic miracle as an example to call for lower corporate tax rates. And that's why Ireland is so angry about the EU ruling because of something more important than $14 billion. It's also incredibly valuable, but it can't be put into the same exact terms as Apple's intellectual property. It's Ireland's reputation. But now, after watching this video, you know what Ireland's strange, empty economy really is. And we also know that statistics are like a bikini. What they reveal is only a hint, but what they hide is what really matters.